The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Gioca, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioca.
Max Out Savings Show. I'm Ted Gioca, and we're talking savings, investments, and your retirement here on the show. Our show is all about building up wealth, understanding the world today, and navigating through very difficult, challenging times. There we go. We're still today. We're working on. We're doing video as well as audio going forward. So hopefully we'll have those streaming on the website here shortly on AM 1070 Answer website. So it's exciting. The Max Out Savings Show. We've been around for about 20 years now, talking about savings, investments. Your wealth, understanding the world today. Our motto and our philosophy is to save aggressively and invest conservatively. That's the key to building up wealth over the long term. Save aggressively, invest conservatively. And we always start talking about that. And the show really, it's been 20 years. It's been a great run. We're one of most Houston's more popular financial radio shows. We try to bring information to you that you're not getting anywhere else. In 2007, we were talking about the problem in the housing market, how it was going to spread to Wall Street, how there was going to be an investment banking failure. I really thought, I remember driving home from the radio station thinking they're going to pull me off the air for saying that. And we tended to be correct. The only thing is we thought it'd be Lehman Brothers first before Bear Stearns. We laid out the case in looking at the balance sheets as we understood. Back in January, late January, 1st of February, COVID was spreading around the world. Everywhere in the media, they were telling you it wasn't a problem. We said it was a very serious problem. We talked about the Lancet study coming out of the UK. With the spread of the R naught factor. We explained what an R naught factor is. I don't think we even mentioned it before we mentioned it. And we simply pointed out that, well, why is China shutting down all their capacity, their industrial capacity, if it's not a problem, even though a lot of my doctor friends assured me it wasn't. So we really try to bring these things to you, to bring big issues to you so you can understand the world today and understand how to deal with retirement. With retirement, you have 25 years. The numbers are simply this. A married couple, if they have about a 50% chance one of them lives to be over 90 years old. And it's not just 90, it's higher than 90. That's a good deal, but the problem with it is you're going to, oh, this is great, I'm going to live a long time. But the problem is that means your money has to live a long time too. And so we try to talk a lot about that on the show. You've got to conservatively manage your money. You've got to deal with these big issues, and you have to deal over a 25-year time frame. Almost any 25-year time frame. We've had inflation, we've had wars, we have stock market crashes, we have all types of things out there, pandemics. You never know what's going to happen. And so we're trying to bring those to you. We try to help you protect your money and protect your wealth. Now, this is a big week this week. We talked about last week in the show. We think you're really going to know what's going to happen. The meeting with President Xi of China and President Trump was a big deal, particularly, we said, because of the Iran war. And looking at that, there wasn't a lot done. A lot didn't happen, which was somewhat of a disappointment. In addition, this week we really saw a lot of movement in the bond prices, which is something I think we want to sit there and watch closely. And we're going to be discussing those here on the show today. It's really big news. So really a lot happened this week. with the markets. A lot happened in the world stage, and so what we're seeing is we're seeing big changes happen rather rapidly. The markets near all time highs in here, and that's not the best situation given the what we're dealing with. So the market's at all time highs, and yet we had a huge global surge in interest rates. So what's going on there? We're going to be discussing that. First, I want to touch base on a couple things here. Looking over at the Bloomberg here, I wanted to sit there, take a look at the futures contract for the Brent crude. It hit actually $126 here this week. It continues to go up, and so what we were saying, what we really been saying is look, we're going to find out what's going to happen with Iran this week with the message with the conference between Xi Jinping and Donald Trump. We were hoping we're going to see something happen. Nothing really came out on Iran. This means a couple things. Either Iran is Xi and Trump have agreed to do something maybe in a week or next week or so, but they don't want to. It's going to be behind the scenes because he doesn't want to look like he's caving to Trump. Or maybe Xi Jinping is looking at this and going, well, look, if Iran gets its way, if they get the Straits of Hormuz where they get to collect tolls and Iran is effectively put in charge of the Straits for Hormuz, wow, that's an opportunity for us. We can claim the Taiwan Straits in the area around Taiwan as Chinese territory, and any ships going in and out of that, we can collect tolls there, and then we can put a stranglehold on Taiwan. That's a pretty big negative. So in addition, there was a lot. Okay, so when that happened, oil prices, the Brent crude went over $126. People are like, oh no, if nothing's coming out, this means that nothing's going to happen. It's going to take time. Look, the Trump administration has done a remarkable job of convincing everybody that this war was going to end next week. And they've been doing it for the last 9 weeks. For months now, they've been claiming the war's ending next week, and people have bought into it, and it's kept oil and gas prices down, but that's starting to wear thin, and underneath it, we've been losing about 13 million barrels of oil a day coming out of inventories, and we can't keep that going. And at best case, if the war ends this afternoon, President Trump says, we got a deal, the straits are open, the ships are coming across, it doesn't make any difference. It's going to take those ships a month or so to get things. It'll take months to get back to production. It's still, you somehow got to replace the depleted oil. It still means oil prices are going to stay high. And so I think it's starting to dawn on people that we have a real problem. We had high inflations coming out again this week, higher inflation numbers. So we're clearly dealing with some big issues here that aren't the most positive in the overall markets. And so you have to, I think, understand that this oil situation is the real deal. It's clearly a big issue. And look, we've had a lot of earnings. All the companies, they're all hitting their earnings estimates. It's fantastic. So oil has gone up to over $100 a barrel. It's not even affecting anybody at all, except a few airlines and a couple cruise ships. Well, most big companies, they're buying their oil and gas and stuff 3-6 months into the future. So they're kind of hedging everything in. You're not going to see those prices increase till the new tankers come in. And from what I'm hearing, we've heard a lot of talk about oil at 105. And if you go call up and you order a tanker of oil, you're not getting it for $125. It might take $110, $120, or even $130 to get that oil into the market. And one of the other lots of just huge big trends are happening in the world today right before our eyes. AI, the build out of AI, the reshoring of manufacturing to the United States, the issues with the Iran war. And one of them is really the end of the commodity exchanges, the COMEX setting prices. They don't set prices anymore for oil. They don't set prices for gold and silver, because if you go buy those places in other parts of the world and you want to buy the commodity, and even in the United States, you have to pay more than that typically. The commodities are basically just the exchanges are simply to hedge and for speculation purposes. 20 years ago, if that they were pretty close on the price. What you were paying on the COMEX was kind of what you were paying, and there was delivery charges, or depending on what part of the world you were in, but those were pretty close to the numbers. That's not the case anymore, because the derivatives markets are so big that they're kind of their own little world. And so it's giving people a false idea of oil and gas price. I think oil and gas prices are going higher. I'm not seeing any settlement out of the Middle East. And this is going to affect your retirement. It's going to cause higher inflation. It's going to cause issues with the markets eventually. And one of the other things is, if you look at it, I was talking to some friends of mine, and I don't know where this came from, this idea of, well, why don't we just pull out, let them take the tolls, we walk away, they take the tolls, they control the Persian Gulf, it's no big deal. It is a huge deal. It on so many levels. What it simply means is Iran controls the Persian Gulf. Iran is so Saudi Arabia, Kuwait, Bahrain, United Emirates, they all going to have to go kowtow to Iran. Are they going to have to be paying tolls for their oil? But it's an even bigger deal. Does this mean that China is going to sit there and control the straits around of Taiwan? Likely they're going to want to put tolls on. They could put tolls on the semiconductor chips, and you go, well, Ted, they'll just fly them on an airplane. Oh no, you're flying over our airspace. We're going to put a toll on that. The Straits of Malacca down there around Singapore, got to put a toll there. Why can't Chile and Argentina put tolls on the Straits of Magellan? It's going to lead to the complete breakdown of world order and freedom of the seas. It's going to put back 80 to 100 years global trade. It's absolutely disastrous. But it's even worse than that. It'll be the first really honest major defeat. You could say the Vietnam War was a major defeat. Honestly, it really didn't hurt us. This will really hurt us, because people are going to go, look, the U.S. they went and bombed Iran. They couldn't accomplish anything. Not only did Iran kind of win the war, but then Iran, we gave them the Straits of Hormuz, control of that. If they'll just let us go on our way, and then we agreed to move our bases. Well, there's not a country on planet Earth will sit there and believe anything we say going forward. Right now, no one really trusts us on Taiwan. We're in a tough place in Taiwan because China said, look, we're going to take it one way or another. I think people sort of understand that, but we cannot cut and run on the Arab countries, because it will be the end of the United States global power. I mean, this was a foolish war to get into in the first place. We were basically Trump was duped into getting it. And our intelligence people, from what I've heard, have told him this was not going to go well. And he believed other intelligence agencies. And so here we are now. But the problem is, we're here now, and we have to do something about it. And so I don't think it's why this is important. It's not easy just to cut and run on this, because the longer term consequences are very big. I mean, Trump's strategy of almost kind of letting them, if they're going to close the straits, let Europe and China and the Asian countries sweat it out some, is not a bad strategy. But in the end, we cannot let Iran have a toll road on the Persian Gulf. And and so people come to me, well, Ted, that's because the straits, to go through the straits, you have to go right by Iran's coast. No, you don't. The deeper part of it is around Oman. The problem is they've mined parts of that, and they've mined parts of the other side too, of the Iranian side. And so people are having trouble getting through. The Iranian side's probably clearer of mines. So you can't let the idea that in order for us to get out of this war and just back away, we're gonna give up the idea of freedom of the seas is just incredible. I mean, this goes back to Tripoli, when the United States didn't even had to form the Marines to go on ships to sit there and stop the Arab countries from raiding raiding ships and taking slaves. And well, freedom of the seas was one of the centerpieces of what the U.S. was able to do, and to cede that to Iran is completely foolishness. And so understand these are big concepts. They're big issues. This is affecting global energy prices. It's going to affect inflation going forward. We're going to see more inflation, and it's just not a good situation. And we're going to talk some more about that. We're going to talk about, look, we had big moves in interest rates this week, and where do we go from here after this? And we're going to discuss that and talk about that right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioca is taking your calls now at 713-339-1070. Ted Gioca will return after these messages.
I'm Ted Gioca, and I approve this message.
Max Out Savings is looking at rising interest rates, the bond market, and our country's spending to project the impact on your retirement. They use that data to help you flex to current conditions with your future in mind. Call 713-627-0400 to learn more. That's 713-627-0400 or maxoutsavings.com. Remember, you can hear the Max Out Savings program right here Saturdays at 10 a.m. on AM 1070 and FM 1033. The Answer.
Once again, here's your host for the Max Out Savings Show, Ted Gioca.
Welcome back to the Max Out Savings Show. Wow, what a week. Want to discuss interest rates. We've had some big moves up in interest rates. We take a look at the 10-year interest rate here on the weekly chart. It's hit effectively 4.6. It's just 4.4595, but 4.6% on the 10-year. It's up 5% year for the week. 10-year interest rates are up 5% for the week. If you take a look at the 30-year bond here, which I got a picture, one of my charts here, looking back, the 10-year bond is the 30-year bond is up 5% as well on the week. It's yielding 5.12%. Now, this is the highest level since 2007. So we're talking nearly 20 years that this is the highest interest rate on the 30-year bond, and it's up 5% this week. It's broken out above the levels. So in both cases, we've seen breakouts on these interest rates the 10-year hasn't broken out as much as the 30-year, but the 30-year, which is more concerned about interest rates, are looking at these higher inflation levels this week, and people are becoming worried. They're looking at $100 oil prices for a while. They're looking at inflation, and it's coming in the system. But the issue isn't just in the United States. If I look at the Japanese here, it's at 2.7%. You say, well, Ted, that's pretty low. Well, that's the highest level for the 30-year, 10-year bond in Japan since 1997. So you're talking nearly 30 years, 2.7% there. But it's around the world, the UK as well. UK rates are 5.85%. Now, to be fair, the UK is a complete basket case, but those are the highest rates since 1998. Again, breakout numbers across the world on longer-term interest rates. People are becoming afraid of interest rate, of inflation. They're afraid of our out-of-control spending, of $2 trillion deficits. We've had $2 trillion deficits for years now. In some cases, over 5% of GDP every year. How long can we keep this up? So what's going on? This is not good for the stock markets. Interest rates affect the markets. It's not good for it's a warning sign for inflation. A couple things. What's happening here likely next week? We have a new Fed governor coming up. New Federal Reserve Chairman Kevin Warsh. Typically, markets have pressured or tested the new Federal Reserve Chairman. Look, there's all this talk. Chairman Warsh is going to be cutting rates. He's not cutting rates when global interest rates are going up like they are now. at the next meeting, or probably the meeting after that. He has to look tough. He has to sit there and say, hey, I'm taking charge. We're going to make changes. We're going to try to work with the Treasury to try to cut interest rates, cut the debt, and then interest rates will go down. We're going to be responsible. We're not going to keep flooding the system with money. Money supply has grown since the market went down in 2020. 23 three in so the interest rates, the money supply since the start of 2024 has gone up about almost 4.2% a year. They're flooding the system with money. They continue. The Fed's balance sheet's been going up. Somehow the new Fed chairman has to come in and go, guys, I have a plan. We're going to get out of this, just like Treasury Secretary Bissett. I have a plan to try to reduce interest rates and reduce the deficit. We're going to try to reduce interest rates. We're going to reshore manufacturing to the United States. The economy is going to grow. We're going to put tariffs in place. We're going to use that to pay down the debt. And the same thing, the Fed chairman goes, look, we have to come up with a new plan. And right now, they have to force or make it so banks in countries around the world want to own treasuries, particularly treasury T-bills. So they're buying the T-bills to keep our debt down. So he has to come up with a plan. He needs to show he's serious, and his plan is going to help the banks and it's going to help the Treasury reduce their deficit and thereby reduce interest rates. And so they're testing it. Or so is he going to do that, or is he going to be like typical Fed chairman and be Santa Claus, and if the market goes down 7%, is he going to come in and announce emergency stock, bond buyback programs, emergency Fed rate cuts, and we're going to flood the system with even more money to keep the stock market up? At that point in time, the dollar's going to start plunging, and people might completely abandon the United States bonds, thinking these people are just a bunch of drunken sailors when it comes to spending money and printing money. And so this is important. What we're seeing is we're seeing the start of a new regime at the Federal Reserve. Inevitably, people forget. I think Alan Greenspan came on in August. His first month, I believe, was August of 1987. You remember what happened in October of 1987? It was not a pretty picture. And by the way, those interest rates kept going up during that time frame on the 10-year as well during that time. People would say, well, it doesn't make any difference. It's really not a big deal. Don't worry about it. And they've kept, just like they're kind of doing now. And they weren't a big deal until they were a big deal. And then they wanted to see how that Fed chairman's going to act. And so I think the market is positioning to start testing the new Fed chairman. Is he going to be basically a Donald Trump yes man, cut interest rates and flood the system with money, or is he going to be tough, which is likely going to be, he has to show he has some backbone. Otherwise, people are going to lose confidence in the Federal Reserve. So this is a real interesting thing. As we said, this is a global phenomenon. Interest rates are going up. Inflation is going up. We had about worse than expected inflation number this week. So it doesn't take a rocket scientist to see this when the price of oil is going up because the Straits of Hormuz are closed. But remember, there's also refineries there. They make gasoline, jet fuel, diesel fuel. They also produce aluminum. They produce helium from the natural gas trains in Qatar. They also produce fertilizer, urea, sulfur. All these things are going up in price. Chemicals are going up in price around the world. They're derivatives of these different things. And so we're seeing, now those are the initial products. So if I'm building something, I've got to go call up to get the raw materials in. Well, the prices of everything is going up, which means the price of what I'm going to do going up, and the price of transportation is going up for diesel fuel. So everything, if I'm a buyer for a company, everything I'm looking at is going up in price, and so then there's going to be more price hikes out there, which is more inflation. And the markets are sniffing this out, and they're pushing up bond prices. Now, the question comes in: is this, sometimes inflation is good for markets. But at the same time, we've got to, a market that hit all-time highs. 2 days ago, it's at all-time highs. I mean, AI is coming. It's going to change the world. Everything is good. And the question is, Thursday, the market hit an all-time high. It hit 7,500. At the same time, as we said, the long bond went up 5% this week. What's going to happen next week? Next week, higher mortgage rates are going to come out. We're already having a bad month for housing. It's going to get worse as long-term mortgage prices go up. This is going to slow housing down. So we're dealing with a lot of issues, and so I think you got to start being a little more careful in here. We had a good week in the market. We had an exciting new offering, a company called Cerebus. They make very large computer the CPUs for AI, but they're big as a dinner plate, and they put everything on the same plate, so the memory is right there, and it can move faster. We'll see how it works. It's like $100 billion company. The stock gapped up. A lot of new issues coming out. SpaceX is coming out. We're getting phone calls on SpaceX. They're talking 1.75 trillion. They're looking to raise about $75 billion. Quantinium is coming out. They're going to raise about $1.5 billion. That's going to come out here in the next couple of weeks. That's a spinoff from Honeywell. We own Honeywell, full disclosure for clients. But the problem is how much new issues are going to come out. Let's assume in the next 3 months, $100 billion worth of new issues come out. Were they not in market cap, but in actual, they're raising that much money. Well, if we look at that, if we look at the ETFs, it's about $450 billion year to date has come across on ETFs, maybe 500 billion in equity ETFs, which means you're looking at maybe 20% of all the ETF money that's come into the market is going to be dumped back onto the market because they have to somehow come up with the money. This is new issues coming back, and so this is more supply. So if you're buying into SpaceX, well, you might have a bunch of Tesla you're going to sell, because particularly retail investors, they typically don't have huge pots of money that they can infinitely buy stocks. So if they see some new issue they have to sell something else to get into it, and so again, this is we have new issues hitting the market right now that are coming on. They're talking June for SpaceX. I think we'll see that happen. We have higher interest, a global rise in long-term interest rates rising. And we have higher oil prices now and shortages of commodities around the world. Now, at the same time, we have AI, the greatest boom in history with the massive build out. And we've been saying $500 billion worth of factories coming back to the United States. And I've used that probably 9 months ago. And since then the AI numbers have only gone up, but I think you've got a solid $500 billion worth of factories coming back. So that's a positive. But again, that increases the demand for more commodities, which is going to increase inflation. And so you're going to see inflation going up as well. And the question is, are we going to see a crowding out of the demand for money? If there's a huge demand for money for all these new private equity, these new deals like SpaceX, Quantinium, Cerebus, maybe OpenAI comes out. That maybe not because of the lawsuit, but some of the other ones, Anthropic, all these people. There's a ton of them. I read that there could be 30,000 private equity companies would like to go public or be sold so they can get money back there. So where's the money going to come to buy from that? Okay, the AI is going to have $800 billion worth of AI facilities, money spent this year. Where's the money coming from that? The United States government's borrowing $2 trillion this year, approximately. Where's the money going to come for that? Plus, we've got probably a couple $100 billion more worth of factories where companies have to come from. Where's the money going to come from that? And I think you're starting to see it. You're starting to see interest rates go up because they're like, hey, there's a bigger demand for money. There's more inflation. And so people they're going to they're being cut out to some extent, or they're going to have a hard time borrowing. At the same time, some of that money is going to come from the stock market. One very clear area that is going to be in the AI guys. Look, if you look at Microsoft, you look at Google, if you look at Tesla, if you look at Google, Meta, if you look at Amazon. Okay, Apple, like, we don't care. We're just going to keep buying back stock. We're not going to invest in AI. But the rest of those guys, what they're doing is they're like, look, we're spending all this money on AI. We're building out data centers. NVIDIA, same thing. But all of those guys had massive free cash flow. They each had a moat around them. Meta had Facebook, Instagram. Google had Google Ads, and we're following everyone on the internet and tracking all their information. Amazon had the Amazon data centers in storage in the cloud, and then they have the Amazon stores. In Microsoft, they basically control the much of the corporate computing with Windows and Excel, and they're dominating that. If you look at them, Tesla had cars and different things, but they're all spending money on this type of stuff now. And so the question is, they all had moats surrounded that were basically almost monopolies in many cases. Now they're competing against each other. They had massive free cash flow. Well, right now, they're spending hundreds of billions of dollars. Same with Oracle, hundreds of billions of dollars building out data. All their free cash flow is gone. What were they doing with their free cash flow? They were buying back stock. So we're going to have, they're not able to buy as much stock back. You've got $100 billion worth of new issues coming to the market. They're all going to be, they're going to need to be selling stock to get it. You've got all these big issues. You've got higher interest rates are now competing with stocks. Like, hey, maybe I should just go over and collect 5.12% in the bond market and not worry about the stock market. All this competition is coming for the stock prices. And the question is what is, we talked about in the show a couple times the last couple of weeks about JP Morgan's got about 5 or 10% of their asset side, which is the kind of loans, maybe it's their liability, depending on how you look at it, that are actual loans. So the rest of them are reverse repos, lending stock, lending securities, buying securities. Basically, they're doing business with all the big hedge funds. So the hedge funds come up early in the morning and are like, yeah, here's $20 billion worth of treasuries. And they go, okay, we're going to give you $100 billion worth of cash to sit there and trade the markets and manipulate the markets so you can make a bunch of money. True story. That's not an exaggeration, by the way. And that's kind of their business. Well, this is not in the best interest of the United States. It's not in the best interest of a stable financial system. And it's also creating different types of AAA paper that are competing with government treasuries in very complex ways. So they're going to have to straighten that stuff up. They're going to have to reorder the banking system. This is why you see JP Morgan step up like a bunch of big guys and go, hey, we're starting a $1.5 trillion fund to lend to new companies, to the reshoring of manufacturing in the United States. Well, what they're really doing is they're like, oh my God, we don't have enough loans. We're running basically lending in all the hedge funds. What if this, and there's pressure now from the government and the Fed, like, we want you guys lending money. We don't need you guys basically carrying on like a mini Federal Reserve to hedge funds. And by the way, this is very, very complex, which I'm not even going to try to explain on the show. We do a lot of work, and it's an enormous amount of work in this area because we think it's a big story. You're going to be hearing more about this, and just I think this could affect markets as well because it's going to drain further liquidity from the stock markets. Because what we want is our banking system to be lending to new companies, to reshoring, to AI, to build out, to people, to homes, not to Wall Street. And this is what's not being said out there, and it's probably not going to be said, but that's and so that's going to be put further pressure. So I think you're seeing big changes. Tell you what, we're coming up here in a break, but this is not real good for the market. We've listed a lot of things that are starting to really build up and be questionable in here. We'll be right back right after this quick break right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioca will return shortly. To speak with Ted Gioca now, call 713-339-1070. Back in a moment with the Max Out Savings Show.
In the 1970s, the big song was the Bee Gees' Staying Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioca of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
We return now to the Max Out Savings Show. Here's Ted Gioca.
Okay, welcome to the Max Out Savings Show. This is actually our second video. We're going to be doing video streaming it. If you got a question or comment, you can give us a call at 713-339-1070. That's what Charles did. Charles, welcome to the Max Out Savings Show.
Good morning, Ted.
Morning.
I had you mentioned one thing, and I have a question on it, but I have a second question. The first question is, you mentioned about a spinoff on Honeywell. What does that spinoff company do?
That is called Quantinuum. They are in quantum computing, which I think is we desperately need quantum computing because you get a huge reduction in energy usage. It uses 1/10 to 1/100th the energy, and they're probably one of the leaders in quantum computing.
Okay. The second question is with regard to all of these the data centers that are being built across the country. How are these things being financed? Are they being financed by the Metas and the Microsofts and et cetera, or is the banking industry involved, or is this private equity? Who is financing this thing as such, and what kind of rates of return are these people getting on that, or are these all internally financed?
A good chunk of it is internally financed in borrowed money. The other part of it is a lot of the private equity guys are getting private equity, and in some cases private debt are coming in and saying, we'll build it if you give us a guarantee on that type of thing. And that they're bringing in that as well. There's some bank debt as well, but it's a lot of bonds right now. But the really big one is they have this free cash flow, and they're redirecting it into the data centers.
Okay, now with respect to the build out of these data centers, assuming that the permitting and all has been approved, typically what's the construction time on this kind of stuff? Is it like a refinery or an LNG plant, or is it much shorter, or what is it? Because as I understand it, the president told these data center operators or owners that they were going to have to build their own power plants and all for power on this stuff. What typically, to get this thing up and running, what did we talk of 3 years, 5 years, or what?
I think the original ones, it was a little quicker because they just kind of cut deals with the power companies and got them started. And those typically are, I think they're getting close to 2 years, 3 years is what they, I'd say 2 years. But a lot of them are being delayed, and it's getting stretched out because they can't get the equipment, they can't get the chips. So they're starting to come on stream. But that's what we're looking at. I'd say 2.5 years.
Okay. And then since you mentioned about quantum computing, I don't know if these data centers, is it? As quantum begins to pick up, and of course we're not quite there yet. But
no,
what's going to happen to all this money that's been sunk into these data centers? Are they going to how are they going to be able to essentially turn over and now embrace the new quantum technology, or is that going to be easy or difficult? Or what are your thoughts on that?
Likely, look, that's probably 10 years off to get anything
Yeah.
reasonably good. And so these data centers, particularly the ones built in the next couple years, they're going to get paid off reasonably quickly. The question is, there's like 2,000 data centers or something come out. Do they overbuild the things, and that's kind of the danger on those. And that's what we're not real sure of. I mean, if you listen to some of the stuff on the data centers, let me just pull something up. Bear with me just a second, Charles. It was interesting. I actually looked at it, and there's that big data center up in Salt Lake City that they want to put in. The guy from Shark Tank, Mr.
Oh yeah, Mr. Wonderful, yeah.
Yeah. They're talking about it's so big, it's comparable to detonating 23 atomic bombs per day in heat coming off of it. And it's going to use like twice as much energy as the state of Utah. And that's just, I mean, these things are, the problem with these data centers, they're reaching a point where, and think of all the water and stuff and the water vapor, and you're talking almost terraforming the world with the planet Earth with these things are so big. And so, I don't know what they're going to do, and this is why the quantum computing is so important.
Well, it seems to me if it's throwing that kind of heat, it almost seems like they'd be looking at something like liquid sodium or something like the nuclear reactors to cut down on the water usage or something. Because to me, it just seems kind of far fetched. But one last question with respect to the price of oil and how this is all tying in with interest rates. Where do you see? Obviously, of course, this is a function of what's going to happen with the Strait of Hormuz, but where do you kind of see the interest rates peaking? I mean, we're at roughly 5% now, I guess, pushing close to 5. Do you see anything going beyond that, or do you think? What are your thoughts there?
I tell you, that's a good question. I think let me look at the chart, because I was looking on the 30-year. I think it could get. I mean, it's a hard one to see on that. I think it's going to challenge. I think at a minimum, it's going to go up close to. I think you could see maybe 5 on that. I think it's going to have to get up there where it kind of, it almost has to go up there till it causes some type of panic and then pushes the markets down, and then it kind of reverses. I was looking at some other stuff on the 30-year, and the 30-year is actually up on a relative basis at a higher level. And let's see, and I had about. And right now we're at about 5.12. I had 5.25 to 5.5, where I felt like it would kind of run into some resistance. But it's clearly
historically, I mean, if you go back to some of the several decades past, to see exactly when did the market start to sense that, hey, if you can get these kind of rates on almost a risk-free basis, as opposed to taking risk in the market, then you could start to see people selling and moving that money over into those kind of treasuries or whatever.
Yeah, and I think it's about 5%. Look, I talked to some very smart people here about a week or two back, and they think the 30 years a real opportunity. So so we're watching that real close, but and it's going to have to come out of the Federal Reserve. I think the real thing to watch is Kevin Warsh, and I think he's going to have to sit there and really make the case, and that they're clearly pushing him. If these guys can get away, if do what they want to do between Bissett and this is a key point, between Bissett and between Kevin Warsh, they have the ability to sit there and take the whole rate structure lower, because you got remanufacturing coming back to the United States. You have AI. You've got, hopefully you get the Iran war settled. It's going down. But the key is these tariffs create income which reduces the deficit. You've gone through with Doge and reduced government spending. You further reduce government spending. You're getting good tax money coming from a stronger economy. That reduces it, and confidence returns. And as that confidence returns of the Treasury Secretary Bissett and Trump with the handling the economy, and then a key is Kevin Warsh at the Fed. If these guys are going to look responsible, hey, we're willing to accept lower short-term rates. That further cuts the deficit. It becomes a virtuous cycle. But we've got to get there first, and we're not there yet. And I think before we get there, I think the market's going to get hit.
Well, and the other thing too is if they can get to the part where they can start to lower the rates, of course that may be just a ways off, but once that happens, that'll also be positive for the real estate markets and the housing and everything else as well.
Yes. No, I think so, and we're already in something with the housing right now. We're looking to get more into that sector on this pullback. I do think we're going to get some changes, but I think people. There's so much going on. They're forgetting that we have a new Federal Reserve Chairman coming up, and Kevin Warsh has been very astute, kept his mouth shut, answered the questions, and not really said what he's going to do. I think he has much bigger plans to restructure the Fed than people realize, and that's going to it's going to start showing up in asset prices, particularly the bond market structure, and that's what we're going to be looking at. We're dealing with some very high level people to try to really understand this and get ahead of this when it starts happening. And we'll try to bring this to you on the show.
Okay.
Good
well,
question.
Thank you very much, Ted.
Thanks, Charles. So we're just talking about the we got a new Fed governor coming. So we have a lot of things happening. We have a stock market at all-time highs. We got a whole bunch of new issues coming. Look, I think you just have to be a little bit more cautious in here now with this market. As we said, we've got rising interest rates around the globe. Look, this week it was not a good situation. I mean, we had rates surging in the UK. We had the 10-year in Japan. It was up about 9%, I believe, 9% in 1 week. I mean, these are not good numbers. The 30-year in the United States is up 5%. So again, not real good not the type of things you'd like to see happen in here on the market. The 10-year is up as well, and so globally interest rates are rising. We have inflation rising. We had 3.8% on the CPI. Look, that's a long way from the Fed's target of 2%. It's almost becoming a joke, and I think this inflation is kind of just starting with all these shortages out of the Persian Gulf. I mean, we were all over this during the Ukraine war before anyone even knew what happened, that this was going to cause huge problems with inflation and commodities and different things. We pointed at the time that gold was going to be a huge winner of this, and we were spot on. And so we want to try to get you to understand this. The question is if they can stabilize this thing, if they can get rates down, what does that do to the gold? And we're studying that as well. So we have plus we have $100 billion, we think, of new issues coming to the market, which is going to put further pressure on the market. And right now it's May. In a couple weeks, it's going to be June. And we got July, August, September, October, November. We're coming up on the presidential, on the midterm elections. I mean, people are concerned that President Trump is going to lose. We've been thinking he's going to hold the House and the Senate. We think and that thinking has been kind of buoyed by they've restructured some of these districts so they're a little more fair. So and I think that's going to help the Republicans win more districts, particularly in the South. And but we're also counting on the 250th anniversary of the United States to create a lot of patriotism. I think President Trump is going to look really good in that. And I think it's going to give people confidence in the United States when that happens. And this is going to help him in the elections. I know the consensus has really been we're going to lose the midterms, and the higher oil and gas prices aren't helping. It's important for the president to sit there. Honestly, the best thing he can do to win the midterms is turn off his Twitter or whatever his account is on the social media platforms, but no one's ever been able to accomplish that, so don't count on it. But so anyway, so that's what we're looking at. We got the 3.8% inflation, rising interest rates, rising inflation, rising commodity prices. These things are all starting to add up, and we're really seeing some kind of issues with some of the tech companies. I think they're struggling a little raising funds. Not really struggling, but people are becoming concerned about the amount of cash outlays on these things. Everybody can't be a winner, and so the question is, what prices do you pay? And so I think it'll be interesting. It's fascinating. Number of areas: the housing sector, the medical sector, retailing, all down. Is starting to kind of indicating some type of slowdown here. A lot of it is just positioning in the market. I think the real key thing to watch is to watch the 10-year and the 30-year. The 30-year bond rising like this is just not going to help the housing market and put a lot of pressure on everything. So the key thing we want to watch is what's going to happen with new Fed Chairman Kevin Warsh. That's going to be one of the keys going forward. I know some of this stuff is very complex. It's really in the weeds. We try to make it pretty simple for you, but I want you to kind of get ahead of what's happening in the world. And that's why we bring these things up to you, because if you're ahead of the game, that's when you do much better and you can protect your assets. I think now you want to increase kind of your risk management in this market. We'll see. A couple of things. If you need some help, we're going to put together our Max Out Savings Report. We're putting another one out here discussing some of these big moves in the bond markets, inflation, what's happening with Kevin Warsh, what's happening with the Federal Reserve, what's happening with Iran. We're going to be writing about this in our Max Out Savings Report. It's completely free. We send it out once a month. We have done some very, very good calls in this report, way ahead of anyone else on major crisis. I think we've had top Wall Street. We've had Wall Street chief strategists get our report. And it's completely free. We don't call you up. You're not signing up for anything except the report. Just go to the website, maxoutsavings.com. You can sign up for free report. If you need help with your retirement, we don't manage 401ks. We manage retirement rollovers. Old 401ks, people roll them over to us, trust, those type of things. We're using our value investing approach to the stock and bond markets. We typically invest in stocks, bonds, mutual funds, using our value investing approach. We hold the assets at our custodian is Charles Schwab. So if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. We'll see you next week right here on the Max Out Savings Show.
This has been the Max Out Savings Show with Ted Gioca, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioca on AM 1070. The Answer.